Hi folks, Scott here, and this is the wrap for Monday, October 21st. I am back in the saddle after an amazing vacation at Disney World and SeaWorld and Discovery Cove and all that with the family last week. Appreciate your patience while I was gone. I did a pretty good job of keeping my morning comments up to date, and it was a pretty good week. Looks like I may have missed out on a good week. I traded one time for one win, which was nice. It was the only day I said in my comments that I'd be able to trade, and sure enough, it ended up being a tradable gap and ended up being a decent win. But others reported some phenomenal results. In fact, I had one person say they've had 7 winners in a row. Another one said they traded 5 of the last 6 days with 4 winners and 1 loss, and an amazing week. So good going to everyone. Anyhow, I'm back. Let's talk about what tomorrow may bring us. It's hard to see here. This is going back about half the year here. Definitely been a grinding channel, ascending wedge, maybe you could even call it. Sometimes breaks and gets bearish to the downside. We are stretched, looking very bullish right now. If you look real close, this is today's action. It was a false down day. I call a false down day as a red candlestick that actually closed higher, a little bit higher. It was also a narrow range day, the most narrow range day of the past 7, actually, maybe a lot more than that. So what I thought would be interesting would be to show you the results of fading gaps after an NR7 day, Toby Crable expression, most narrow range day of the past 7, that also closed at a 50-day high close. So NR7 day after a 50-day high close and went above the 200-day moving average. Got a gap trade on my back testing tool. And there you go. It's happened 47 times actually in the past 10 years or so, and about equal odds on which way we're likely to gap tomorrow based upon this. Right, long trades are down gaps, short trades are up gaps. And using an end of the day stop, been attractive in both directions. Higher win rate for longs, but the average loser is much bigger. See that? You can see this, assuming 10 contracts, so you can divide by 10 if you're trading one contract or what have you, or some other multiple. So much average bigger loss, but if up gaps, end of day, very unusual to have a large losing trade. Well, not to mention unusual to even have a losing trade, but if it is, it's not likely to run against you is what this data is telling you. So gap in either direction looks okay. Frankly, I'd probably like a gap up more than a gap down, but we'll take what the market gives us. But there's a little nugget going into tomorrow. As always, I'll rerun these numbers for our members using our MTG stop parameters, which is equal to 30% of the 5-day ATR with some min-max parameters applied. All right, let's look at what the data showed for today. And first, let's look at the worksheet, which all of our members had access to starting Friday evening at 6:15. And you see going into today, at a glance, odds look very good for shorting any gap up. See these good numbers here for gap fill. This is an average of all 8 individual indices gap guides. Strong numbers above the highs. Between the high and the close, even better. If you slide to the right here, one of my little techniques here is I want to see both these numbers above 80%. If not, then I don't go for the extended target, and at least not formally go for it. I may try to ride or hold on to a winner and then manage the trade. But these are less than 80%, so that shows odds were less. May not be worthwhile for holding for the extended target. But good setup. Down gap more neutral. And let's see, up gap on Monday post-option expiration during similar market conditions have been good. A little bit small sample size, but they met my criteria. After an unfilled up gap, good. After an NR7 day, the most narrow range day in the past 7, we had one of those on Friday also good. Lots of positives. Real quickly, let me show you the guides. So when I say between the high and the close, when a day closes up, it's always going to be between the high and the close can only be one zone, the UHC zone. So you look over here, the numbers were off the chart good for the ES. See that? Seasonality system was good, pattern system was good, market condition, good. You just got to trade these. Stop today was 5 1/4 or 5.5 points, extended target 2.5 points. Seasonality looked pretty good. So, and then you could look, see the YM actually closed down. That was a little bit of a wrinkle in things. That gave me a little bit of caution, but UHC zone was good in NASDAQ, good in Russell. Looking at the ETFs, even though I don't trade ETFs, I always look at the UHC zone. Really good numbers there. Again, diamonds were a little bit goofy. I don't worry too much. Q's good, and Russell a little bit weak. So not ideal, but overall pretty strong numbers. So here's how I sized it up this morning. Add a different research nugget. Fading gaps on Mondays when above the 10 and 200-day moving average after a 50-day or higher high close. Up gaps, good. So really not much not to like about up gaps there. That's what I said. The guides are generally attractive, mostly positive factors. I had two primary concerns. I only mentioned one here. And honestly, I thought about it more today. I was a little irritated for forgetting it, but it's neither here nor there. I'm just trying to share so people understand. Despite all of that, only traded a half-size position. I had one concern I posted here. That was the future sold off during the last 15 minutes. That resulted in what I call closing variance. So if you look back on your charts, the 4 p.m. close for the ES was at 1738.75 versus the 4:15 close, which is what the guides are based on, down at 1736.50. That's 2.25 points. The gap was only about 2.5 points up today. So it basically meant the ETFs weren't really showing much of a gap. So that means they would not help the gap fill. There wouldn't be momentum to the downside. That was my primary concern. But the secondary concern that I failed to mention was it was still Monday. While the data looked good on the gap guides for seasonality, just in general, I've learned the hard way. Mondays tend to be a little bit more volatile, a little bit trickier to trade because you've got all these systems and funds that are establishing trades on Mondays that just add some volatility. So I've always, it's the worst trading day of the week historically, no matter how good the setup was. And today was a good one, but in general, out of habit, I'm going to reduce position size on Monday. And I should have mentioned that, but I didn't. Anyhow, for those of you wondering why I only did half-size position with such good gap guides, such good other data, that's why. It was Monday, and we had that closing variance where we were barely gapping up in the ETFs. So I trade with half-size position. Let me show you the price action. Whoops. Markets rallied a bit while I was gone last week. There's the Russell. There's the ES top right here. The Dow futures down below. You can see all the markets consolidated. Very common after an unfilled up gap. And this was today's action in the ES. So see this pretty decent gap, about a 3-point gap here on the ES. Sold off a little bit. Triggered my proximity rule. Missed my target by 2 ticks. I was going 1 tick in front of gap fill. Missed it. Reversed. Well, my proximity rule trigger, I took half of my stops. I posted all this in the trading room and tightened them to, take a guess. No, it wasn't 1742.50, the high of the day. It was 1 tick below it. Yes, I'm still a little irritated. Yet again, another Buffalo trade. On track for my second worst year in terms of Buffalo trades in 10 years. But hey, it's not the worst, not even close. So still, this is what happens with trade managers sometimes. Tighten my stop in half and got dinged right there for minus 3 points on that half. That was disappointing. Good news is the other half I left alone. It rolled over, filled the gap. And I was going for originally the extended target 1734 in that half. I know the data didn't support it, but after it sucked in some longs here, it often will run stops to the downside. So I was going to try to manage it, see if I could get lucky with a little bit of a big bar, so like what we had here later in the afternoon. But the first hour guides, which I don't have time to show you, and the 15-minute guides, both slightly favored the low fade to the long side. So when I saw the first hour guides came out, I said, nah, forget that. I'm just going to try to get back to scratch. So I tightened my targets to 1736. And if you look closely here, it went to 1736 exactly. See down the third red number there is 1736 even. Kid you not, all this was posted in advance in the trading room. I can't make this stuff up, nor would I. It didn't fill me, and I knew reports would bounce because of the range guides. So I went ahead and tightened my stop to just above here, and it went. Said if it went to 38.25, it would close me out, and it did. So I made +1 in the second half, -3 in the first half, for an average of -1 point for a tiny half-size 1-point loss. That was my core account. My IRA, other aggressive accounts, mechanical system, everything else called it for nice 3-point win on the whole position. So even full size of my mechanical accounts. So again, I trade my mechanical account a little bit of a hedge. Because I'm so focused on primarily one setup and one market. It's a form of diversification, as I've talked about in my diversification webinar that I did a couple months ago. Anyhow, caught nice wins, so wasn't a terrible day, just frustrating my core account, my biggest account. I sort of goofed it up today, got buffaloed twice, but that is called trading, and tomorrow's another day, so we'll see what happens. And there you go, that is the wrap for Monday, October 20th.